Hello and welcome to Commodity Culture, where our goal is to make you a better investor in the commodities space. My name is Jesse Day. Before we dive in, standard disclaimer: nothing here is investment advice. Do your own due diligence. And today's episode is sponsored by ARC Silver Gold Osmium. They offer personalized service and competitive prices with no minimum purchase for silver, gold, platinum, or osmium. Here's just some of the comments left on this YouTube channel about ARC SGO and owner Ian Everard. Have bought from ARC, good source and price. I cannot say enough good about Ian and his company. He is the most honest individual I could find in order to buy precious metals. If you are looking to buy precious metals, I recommend Ian at ARC Silver. He is a straight shooter. So go to arcsgo.com and contact Ian Everard today at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And today's guest is the author of Confessions of a Wall Street Whiz Kid and a veteran of financial markets, who has made multiple media appearances over the course of his illustrious career, with the latest being right now here on Commodity Culture. We are honored to have him back. It's Peter Grandich. Welcome to the show.
I don't even remember those when I'm on with you, Jesse. It's okay.
Well, there's been a lot of great ones, and always appreciate hearing your insights. I do want to start with a broad question here, and that is, what are the main themes and trends in financial markets that you think more investors should be paying attention to right now?
Well, as you and I speak, we're about to have this week, later in the week, a big debate, which will go a long way, I think, to how the political landscape will be, and politics will play more and more in a role on markets as we get closer to our election. But the thing I think that isn't being recognized, and I'll tell you my choice on it was, I've never seen, this is my 41st year, and I've been in bull markets and I've been at tops of, where markets have collapsed. And I've never seen complacency among investors and professionals to a level when so many more fundamentals now are far poorer than any other time in the 40 years I've been around. And that complacency uh, allows for, I wouldn't say a collapse, but a dramatic turnaround can happen almost overnight. And I don't think most people, professionals and investors alike, have the understanding of that ramification. Now, what I've chosen for that, Jesse, is back in March, I still have involved with a planning group for U.S. residents, financial planning group, and I said you have to build a financial arc now. The social, political, and economic turmoil to come will be magnified past anything we've ever seen, in my opinion. And I'll just name the five key reasons, and if you want to discuss them, it's fine. One is an old one. You've had many discussions about it. You'll continue to have more discussions about it, and that's the debt and the deficits. The second is a retirement crisis, but also an aging crisis. The third is the immigration invasion. It is an invasion, uh, but I only view it how the economic ramifications of it. I'm not concerned, even though there will be, I think, a bad side note to all this and terrorism coming to American soil and all that. But I look at it just from the economics. The fourth is probably the most interesting one for me because it's the one I think Wall Street in general has totally missed, and that is they don't the understanding of what the BRIC nations are forming and what that's going to lead to. And then the fifth one is the political paralysis. You and I were just talking before we went on the air about how one side just absolutely despises the other. And that's seen in our halls of Congress. The Republicans and Democrats haven't worked for quite some time together to put any real legislation together. And they now each have a splintering group within them that's one is moving more to the left and the other one's moving to the right. So even though come election day, one party will win, I think the people that feel that they lost absolutely will have hatred towards the person that's in there. So I don't see any way that we can make things better. I think things can only get worse, Jesse, over time.
Well, when it comes to complacency in the markets, it's interesting because we've seen several bubbles throughout stock market history. Obviously, the latest being the great financial crisis. Before that, we had the dot-com bubble. Before that, it was the Nifty 50 that collapsed. I mean, like, when you go back to read Ben Graham's The Intelligent Investor, and just the history is very, very clear that now it feels like we're in another one of those eras, with Nvidia basically almost by itself being the poster child, and this whole talk about an AI revolution. And these fund managers who, like you said, they're complacent, they have to be in these stocks because a lot of them are performance based. Their compensation is performance based. They're tracked year to year. It's not a long term view of things. Why does this keep occurring? Is this just an inevitable cycle that's going to continue for as long as human nature remains the way it does? Are these people not understanding? And who knows? We could be wrong. Maybe this time is different, but judging by history, it doesn't appear to be. How do you see this all playing out? Why are people not seeing the bigger picture here?
Well, you have to recognize that the lion's share of people don't look at it as the upper echelon do. The market has been really good, mainly just to the upper echelon 1%, 5%, 10%, whatever top of that pyramid has benefited greatly. The average person hasn't. And listen, 65% of Americans are working paycheck to paycheck. They're never going to see anything remotely to what the people up at the top are used to. And we're seeing that increase. We're seeing more people fall than rather rise. But I think the important thing to look at is just look at the 40 years I've been in it. The 87 crash, everybody said, well, we came back. 2000, dot bomb, we came back. The mortgage crisis, 2008, we came back. Yes, we did. But there was something advantageous then is no longer advantageous. It was bailed out with tons and tons of new money. Because our debt and deficits become so high, because people don't look at America in the same manner that they did economically, socially, and politically during those crises, it won't be as easy, if at all, to bail out again without too much damage when that next inevitable, as you said, because it's historic, it'll happen again. We just don't know when. And therefore, when I look around and I see almost every day new types of people coming in for our planning group seeking help, and 7 out of 10 families are living at least one lifestyle above their finances, Jesse, which means they're living off of debt and or they are not saving for the things that they need down the road and are using that money for really discretionary stuff, not necessity stuff. And it's magnified through all levels from the lower worker all the way up to the professional athletes I dealt with that made tens of millions of dollars. And that cannot go on. That can only go for so long. And I really think that we're kind of at that game when you used to play as a kid. There was one less chair, and as we eliminated, there was 20 of us. And the game kept going 10, but then eventually it was down to two. And of course, one person ended up not getting the seat in the chair. And I don't think many people prepared that there's not going to be a seat for them when all things fall apart.
And let's touch on the debt issue as well, because the government debt in the US is bigger than the entire economy, has recently passed $34 trillion. The people in charge must be aware of how dangerous this is. At least I would assume some of them do. This begs the question, are they trying to break something? I have had Tom Luongo on not too long ago. He believes the wars the US is engaged in are cover for a reset of the banking system and the attempted issuance of a central bank digital currency. Now, some people would call that a fringe conspiracy theory, but it does appear that they're purposefully trying to cause destruction in the economy. Maybe they're just ignorant. Maybe I'm overthinking it. What are your thoughts?
Yeah, I think you're giving them too much credit. I would argue more they're probably more ignorant than sophisticatedly smart to pull off such a rouge on people. You can never say never because you'll never know that if it is for the case. But what I do think is there's now an absence of any person or group that is making any effort to stop this runaway train of debt and deficit spending. We're now running multi-trillion dollar deficits. You know, I spoke recently to a bunch of young financial advisors, all 40 and under. And of course, I was the dinosaur in the room. And I said to them, when was the last time the Congress balanced the budget? And they said, it's balanced all the time. I said, no, it's not. And when I told them the last president was Clinton, The Clinton administration was the last time we had a balanced budget. Can you imagine going almost 30 years in your household without balancing your budget, Jesse? We all know who'll be knocking at our door because you wouldn't be able to keep borrowing and all that type of money. And that's all part of the ignorance, the lack of understanding. I personally believe that 80% of financial advisors to this day could never read a balance sheet and really run a business from an accounting standpoint, yet they're telling people how they should invest and where money should go and all that type of stuff. So I really just think that the deficits, if you just look at that, at the rate we're going, the Congressional Budget Office, which is really the last bastion of any semblance of bipartisanship left in Washington, now says 54 trillion is going to be the number in less than 10 years. Put a 5% interest rate on that, Jesse. That's not high. We're going to have $2.5 trillion in interest expense. Best year we ever had in income was 5.3 trillion as a country. And sure, that'll go up some, but it's unsustainable. We're getting to the point where just paying the interest on our debt could be called into question. And the moment that's clear and obvious to the average person, it'd be far too late for the average person to do anything about it.
I want to talk about the trend of de-dollarization and the fact that Saudi Arabia has officially put an end to the petrodollar agreement, binding them to sell oil in US dollars exclusively. Now they are free to sell oil in any currencies they wish, perhaps even gold. There's some talk that if they sell oil in renminbi, the best thing to do would be to turn around and buy gold with that off the Shanghai Gold Exchange. So I think gold could play a role at some point. What do you think the ultimate impact of this move would be? And is the de-dollarization trend accelerating, do you think, faster than most people expected? Or do you think we're still a long ways away from the dethroning of the dollar?
Well, to the best of my knowledge, first of all, there's no official ending. There wasn't a formal pact signed. There wasn't. It was always an understanding that had worked, and of course, that dissipated the day. If you remember, a couple of years ago, when our oil prices went up a lot and our gasoline prices, and Biden made a quick rush over to Saudi Arabia to kind of scold them. If you remember him fist pumping the Saudis, and since then, the Saudis have looked every way possible to get away from being involved with the United States. So I call it more Bidenomics took part and tear apart whatever understanding of that pact may be. But if you look at the recent news out of the Saudis now, very interested, speaking openly about joining the BRIC nations, very interested in commencing trade outside the dollar and all. And these are all things that I think people are going to get more of an understanding, Jesse, this fall when the BRIC nations formed again. And when they realize it's no longer five, it's no longer 11, but it's going to be somewhere between 30 and 40 countries, and probably with real expectation that that number can get to 100 or more before it's all said and done. And I think only then will some people, hopefully in the financial community, start to recognize that the BRICS is not a joke. It's not anything to laugh at. De-dollarization is a fact. We continue to see less and less usage of the dollar. And all the gold, and I don't want to skip over in case you had questions about that, but the main reason for gold's rise this past 12 to 18 months is because people, countries see the inevitable need for an alternative to the dollar, or at least the world will be broken up into trading packs, and something other than the full faith and credit of somebody's paper is going to be expected to be the reigning or at least compete with the dollar. And that's the main reason why so many people have purchased gold. And gold will be in some form, either backed digitally or some way, shape, or form, used in whatever it does eventually come together. It's still probably 2 to 3 years away, but it's moving in the right direction.
Well, let's move from gold to the gold mining space and junior mining stocks in general. This is a sector that you follow and invest in. Before we hit record today, we were also discussing that sector, and you mentioned that there's just not enough market participation at present. We're seeing a bit of a blood in the streets moment for that sector. Very volatile, obviously. What what are your thoughts on the overall health of the sector and what it would take to turn things around?
Well, if I could eliminate that sector from my history, I'd be phenomenal. I've had some really good years even lately. But when you look at how much devotion I gave to that market and how much my portfolio was down, and how fortunate enough that my wife has not gotten a divorce attorney yet on this situation. When this year ended, Jesse, after the 2 years we basically went through, I basically said, there's no way this can get worse. I mean, we got to be at the bottom. And, we started off, we had a little bit of a rally in February, and I started to pat myself in the back. And here I am, as I told you, as we talk here as we get to the end of June, and we're watching wholesale liquidation today by funds of juniors across the board. And those that remain in it wish they never were in it, wish that somehow overnight, which is not going to happen, be able to get out. And part of that is, and you and I discussed this, and I think it's important if you don't mind me taking a minute or two. The market that I knew, and I had left it for a while, but the junior resource market and mining shares in general, particularly the smaller ones, is a completely different species now. It's nothing like it once was. First of all, brokers and financial advisors don't build book of businesses anymore driven by commission. So they're not out buying and selling individual stocks, particularly in the junior market. So the hundreds or thousands of brokers that used to be in North America built part of or all their book buying and selling junior resource stocks, they're gone. There may be a handful left, but they're a true dinosaur. Well, that junior resource company still needs to meet those end users if all those same are out there. Now, I'll argue they're not. I'll tell you that as much as I dislike, and I dislike a lot, cryptocurrencies, they have stolen the lunch of the junior resource market. The people that otherwise would have been in the junior resource market, especially the younger you go down the age, are over in that world. And so now that junior mining company still has to find end users just like it did 10 or 20 years ago. But the challenge is 100 times harder. And there are whole other things, institutional wise. There's no real mining desk anymore. There used to be mining desks throughout the brokerage community in North America. There may be one old guy like me that they left there. He or she is not seeing any new money. They kind of hold the hands of the remaining few people that own it. So the industry itself has such a challenge from an investing standpoint. And the frustration, and anybody that's still in these things has this, is you see these metal prices. Jesse, if you went to Times Warp and you saw me 10 years ago, 20 years ago and said, Pete, I went to the future. You're not going to believe this. Gold is 2,300 heading for 2,500. Copper is well over 4. Used to trade at 80 cents, $1, $2. Silver's, going near $30. I would tell you the mining shares had the quadruple in price, and yet they're down 60, 70, 80% from highs of recent years. So somebody's got it wrong. Either I got it wrong and I missed the bell, they closed the door and I didn't hear it, or if all this need for eventually for metals that are just to sustain where life is heading, whether it's through AI, EV, general necessities and all, at a time when grades, this is the untalked about story, Jesse. You look at a major producer, the world's largest copper company, it used to be on average 3% grade, that mine. They're down to 0.5 now grade. So they have to move 6 times as much tonnage to get basically the same copper. And that's all around the world. There hasn't been Chile used to put out every 2 years a new mine. I don't think they put one out in a couple of dozen years. So somebody's got it wrong. And if I am correct that eventually one day after all this pain and suffering, we'll wake up and go, oh my God, there's such a need for metals and there's so few people that are ready to go out there, find it and develop it. Until that day comes, it's going to be a tough sled. And I can understand people fully now just bailing out, even though it would be a contrarian's delight to enter here now. But 2 other things have to happen. We need to see what's taking away the interest slimmer, but we don't want it to crash because we don't want that money to be wiped out. And we also need to see somehow, some way, more better discoveries. That we haven't had a world-class mining camp or run where it just attracts people from the outside. And everybody thought that was uranium, and I was one of them. Okay. I did get out early in the year, but and the fundamentals are still there. In fact, to this day, I would argue uranium has the best fundamentals of all the metals. Yet why isn't the price going through the roof, and why isn't most of the smaller non-producers? Because the market that used to exist for that end user doesn't exist at the moment. And the only hope is, will it return? That's what you're betting on.
And so, for somebody approaching the space today, is there a more conservative way that could maybe um, be more successful, guard against the risk of losing such a large amount of capital, these large drawdowns, approaching the sector through royalties and streams when it comes to gold and silver, focusing on the big producers, ETFs? Is this an approach that you think could make sense in the current market environment?
I live my fate on my sleeve, and one of the troubles that I have, and I almost never speak about this, but you're a very straightforward shooting guy in an industry where straightforwardness isn't common. Okay, let's just put it that way. And if you had listened to the top so-called known experts any time in the last few months, you would never know the industry is doing as poorly compared to what they make it sound like. So one of the first things I would caution new money coming in is to try to get a real grip of the understanding of whoever or what group you're listening to, what actually has been their actual performance versus how good they say. We have somebody that's a classic household name in our business, but if anybody ever knew that person's particular track record, they may think twice. But having said all that, this is a business where failure is the norm, Jesse. This is another thing people don't like to speak about. Listen, every 10 companies starting out could be all totally honorable, hardworking, roll up the sleeves. But 3 to 5 years from now, one, two, or maybe three of them found, developed, or sold for profit a potential mine. And the rest won't work out. So it's a highly speculative. And remember this, the word speculation was created by Wall Street years ago, so they don't have to call it what it really is. It's gambling. And in gambling, you got to be prepared to lose part of all your capital and mentally prepared for it. And can I say that? I think that's more important. That's probably one of the most overlooked aspects of our market. People may be able to afford the financial risk, but the mental anguish that this industry causes, I don't know what's worse, that or being a Vancouver Canucks fan. No offense to the Canucks, but they haven't won yet.
Yeah, that's a very good way to put it. The psychology is an aspect that's very rarely touched on, especially when it comes to stomaching the type of volatility that's very prevalent in the sector. I'm wondering, with everything in mind that you've spoken of, people claiming that to have a track record maybe they don't have, a lot of people promoting the sector and maybe giving new investors to the space kind of a false confidence. This is assuredly the commodity super cycle is here, just go all in, rising tide lifts all boats, stuff like this. How do you step away from that noise as an investor and evaluate these companies? What is it that you look for when you're evaluating a junior or any mining company? And how do you just kind of stay outside of all of that promotion and focus on what really matters?
Well, you just don't. That's the problem. Here I am, my 41st year, the largest position I've ever had in anything. The amount of dollars I have in it now, 20 or 30 years ago, I never imagined it would be my worth. And yet I invested in a company that had a phenomenal project, still does. Yet it turned out, and thankfully the top management left recently, it poor management almost took us down for the count. Now we've been blessed and been saved. I really believe it's an act of God for the people that have been brought in. So even someone like me that lived it and breathed this thing for 40 years. So just think about somebody that's new and just looking in. That's why it can be very tempting based on an industry that's marketed much more as performance based better than the reality of all things. I think it's like anything else. I think if you recognize the risk and understand that you're speculating slash gambling from the beginning, I think it's a matter of you've had good common sense. If it's too good to be true, it's too good to be true. And if you hear one person that says, "Hey, listen, failure's the norm. I've lost a lot of money," so forth and so on, and then the next person's talking about this thing's going to the moon. If you don't get in now, it doesn't take much common sense which person you'd probably be better off going with.
Yeah, and I want to talk about jurisdictional risk as well, because that's another very real piece of the puzzle when it comes to evaluating a company. And maybe I'll hone in specifically on Niger at this point, because we've seen uranium companies in that region take an absolute beating due to the fact that there was a coup. The new government came in. Some of those stocks recovered. Even Global Atomic, in particular, I'll call it out. I am a shareholder. The price even went past what it was before the coup happened, and then inevitably some more negative news came out, and it collapsed again. We now recently saw Niger's government deny Orano, one of the world's largest uranium mining companies, notably a French mining company, which many believe is part of the reason for them revoking their permit for the Imararan uranium mine, some 200,000 tons of uranium in the ground there, leading to fears that that could spread to other companies in the region. Um, there's jurisdictional risk in South America. That Canada has its own jurisdictional risk, which is insane permitting times and incredible amounts of ESG red tape and all sorts of things like this. What's the best way to mitigate that risk? Is it being diversified geographically? Do you stick specifically to quote unquote historically safe jurisdictions like North America? What are your thoughts on that aspect of it?
I am well down the stretch in my business and probably personal life as well. So I've taken an attitude that I'm not going south of Miami. So even if they found it in Key West, I won't be involved in it. But I mean that in terms of 20 years ago, I made, and probably one of the biggest successes I've ever had in the juniors was by backing and financing a junior in Mali, which 20, 25 years ago, we didn't worry about. In fact, West Africa was probably one of those hottest areas where mining was developed. Now I couldn't begin to put any dollars into that area of the world. And I think that goes to a good point, Jesse, that if you and I were at a conference 20 years ago and we spun a globe, we just went like this with our fingers, we would have said, oh, yeah, we can go there. Not anymore. You talked about Canada, and you're right. There are some areas. I mean, Quebec, I just came back from a conference, first one in over 11 years, and there, the government, the people that were there from the government, all they are just so proactive mining. So I think there are jurisdictions that will be, but I think once you get outside of North America, you take a lot of risk. I mean, look what happened in Panama. A company put $1 billion, whatever, and they just said, "Listen, those rules are gone. These are the rules. If you don't like it, hit the road." And where do you go? You're going to go to the international courts, and 20 years from now, maybe get a result to it and all. You made a very good point, but this is why the physical ownership of metals is so important. Look what you just talked about uranium. You know, I was a huge bull on uranium. I was buying it when it was $18. Early this year, got above 100, not knocking it. I know it went back, but hey, we had 100 to 500% gains across the board. We had to take some, only to lose it now on paper on junior resource stocks. That shows you how brilliant I am. But look at the uranium argument. Let me just take that for a minute because I know you're very involved in it. Nothing is more bullish other than some very rare metal than uranium right now. Around the world, getting more difficult to find it. All these things are happening. Uh, Everything is moving to higher power. People are realizing that without nuclear, we're not going to have power. Wind is not going to be the answer. Solar is not going to be the sole answer. All that type of stuff and all. And yet, many who a year or two thought we should be at 150, 200, $300 a price. Somehow, some way, these things don't get to that level. But supply and demand. So even if you didn't buy that junior that got hurt in the countries, the area, but you bought the Sprott physical uranium, you did much better. And you were onto something earlier, which I like to come back to. I think for that person that you talked about that's starting, they should look at the more conservative stuff, the royalty companies, the exchange traded funds where you're getting diversified and not trying to pick the one or two that went out. And again, understand that for all the juniors that there exist, I forget what the number is. I think there's over 2,000 listings of junior steel. How many mines will have been discovered and gone into production over the next 5 or 10 years? Couple dozen, few dozen, maybe some more. So out of those 2,000 that you could throw a dart at, What's the percentage that are actually going to go the all 9 yards? So maybe starting at a much higher level and using real gambling money only down at this end is probably the smartest thing for someone that isn't yet or hasn't been around this business. And if you want proof that just because you're around the business doesn't mean it's going to work, you and I can spend hours. I can tell you about all the failures that I've had.
Yeah, very well said. And that's how I approach things. Being fairly new to the industry, only 4 years or so, I approach it by focusing on the large producers and whatever commodity it is, ETFs, royalties, streaming, and then the money that I want to gamble with that I can afford to lose, I'll speculate here and there on a junior. And I think that's a great approach as well. What about outside of the commodities space? You know, we talk about commodities a lot on this show. Obviously, it's in the title. But is there anywhere you're looking outside the commodities space right now that you think might present some value?
So if I had another 10 or 20 years in me, which God willing, but I don't think I'd be even in the same mind frame. Uh, there's two areas I think seem to be no brainers as it anything to do with water. Water is just going to become a more scarcity a commodity, the ability to have it for drinking, taking care of agricultural, and then delivery of power. See, we all got caught up either at the beginning, how do you get it? But all this power that's going to be needed, if anything is close to what AI is, this power generation, all the parts in that thing, the transformers, the way it's carried, people consulting in that area, the builders of that, how power generation is going to be, the parts that are needed for it. And of course, medical. There's always going to be a ton of money. We're all living longer. We're using a lot of medicine to live longer, and that's important. But I will tell you this: of all the commodities, so few people talk about water, and yet it's becoming very, very scarce in areas. And it's a real. And I'm not an environmentalist. I'm not into global warming and that, but I think water is going to become more of a. There'll be more fighting over water soon than anything other commodity I think in the world.
Very interesting. I do want to circle back on something you mentioned about why holding physical bullion when it comes to precious metals is important. You don't take on any of the risks that a mining operation normally does. You know, not only can your capital costs be threatened by inflation, you can get supply chain disruptions, jurisdictional risk, a deposit that doesn't end up being economic to mine. I mean, the list goes on and on with the landmines that exist in the mining space. And yet, physical gold and silver, some would say, is not an investment, but more of an insurance policy against, you know, geopolitical uncertainty, these deficits you were talking about, and the fact that inflation has been very bad around the world, and many believe it's going to continue to be that way. What are your thoughts on keeping some gold and maybe silver as well around to protect yourself from this sort of these sort of situations?
So since 1999, I've been part of a alternative to traditional financial planning group here in the States and just can only handle U.S. residents. And every single person I've had a chance to talk to should attest to that I will always sit with them when it came to, well, what do I do with my dollars and all? I would always tell them to buy some gold and hope it doesn't go up. And Jesse, almost to a person, they'd all give you this look like the dog used to look. But Mr. Grandich, why would you want me to buy something that isn't going to go up? And I said, based on looking at your portfolio right now, given it's all basically in financial assets, I can assure you that if gold goes up a lot, your financial assets went down on average. And so I've always treated it minimally as an insurance. We buy car insurance for home insurance. Most of us aren't hoping that car disappears or the home burns. But if it does, we want something alternative. But I think there's a bigger reason now for the metals. And one of the reasons why they've done so well is the world can no longer just keep moving on paper. There's so much debt around the world. They'll eventually, and you'll live long enough, Jesse, to see it. I'll probably be a distant memory, but I think it will be in your lifetime when people recognize that something has to happen. Either a terrible deflationary wave for several years, and that's how a lot of the debt gets wiped off the books, or the opposite, hyperinflation and monetize and is moved out of it. But it can't keep continuing to grow at that rate without one of those two things eventually happen. And neither one is good. And this is why I argue it'll be an inflationary, because it's much easier to print money than to see people standing on the corner trying to sell an apple for $1. It used to be a dime in our depression, but we have inflation. And so I don't think politicians will want to see a deflation type of thing, but they'd be willing to deal with hyperinflation. And so I think gold and silver are more of a monetary reason to hone, just as you hopefully put cash aside. Some of that cash aside should be in gold and silver, not because it's going to, you want to make a killing in it, or because it somehow turns into a mining company, but the very fact is that it's historically has a couple of thousand years going for it. That's always my argument with the crypto nuts. I call them crypto nuts. They are. It's a cult. People can argue all they want, but you can't say or do anything to them without, there's not even the slightest room for debate and all. And I say, listen, give me anything that has a couple of thousand-year track record than something that has 10 or 20 years track record. I'll take my chances with whatever that was. It's kind of like if you've ever been in horse racing, I've owned them and all. As great as it's good to see a young horse, by the time they're 7 or 8, you pretty well know this one's at this level and this one's at that level. And give me the one that's at that level, because chances are if I had to bet one race, that's the one that's likely to win. And I think gold and silver, which is almost non-existent still in people's general portfolio, despite the performance and what we just spoke about, you'll still find that most people don't have any real exposure to physical bullion, not some mining share. Because one thing we learned this last 2 years, Jesse, and this was said all the time by every name you've ever had on or know about, including yours truly, who's guilty of it. This is what we used to say at gold shows 10 or 20 years. Owning mining shares is just like owning gold. Well, the last 2 years proved that wasn't correct, because the average mining share went down and gold doubled in price. So physical bullion is an important part of someone's portfolio in my book.
The kind of conventional wisdom out there in the investment world still seems to be just put your money in a few index funds, buy an S&P index fund, buy maybe a world index fund, maybe a bond fund, maybe a little allocation to emerging markets. Just get these, a few ETFs. This is the random walk down Wall Street kind of approach to things that, well, fundamental analysis doesn't really work. Technical analysis doesn't really work. So just buy the market, sit back, weather the storm. If you've got a 10, 20 year plus time horizon, you'll do great, because the market compounds at an annual rate of 8%. This is the typical thing you hear. Is that era over? Obviously we saw low interest rates be a massive catalyst for the broad market. Howard Marks has come on record and saying we're in a sea change. We're in a higher for longer interest rate environment, and the so-called easy money, where you used to just be able to pile into the broad market, might no longer be the case. What are your thoughts there?
There's a mixture, but there's a statistic that's factual that doesn't get quoted because it goes against financial service industry. Nobel laureates, people who are independent from financial service firms over the last 10 or 20 years, have done numerous studies, and they found that about 80% of equity fund managers underperform an index fund, and 85% of bond fund managers underperform a simple bond fund. So one thing is for certain, you had been better off simply to gone in an index fund than picking any one manager. And think about that. If those numbers are true, and Nobel laureates, they do pretty good hard work, I'm going to assume that a lot of it's factual. Even those 20% that outperformed, they then demonstrated 5 years later, less than a third of them continued that performance. So unless you could time out and somehow know which ones to go to, yeah, put it in an index fund versus discretionary management. That's why over half the money now, this doesn't get talked about in our business, but over half the money in all the markets are in non-discretionary, not actively managed funds. It's not where managers every day trying to figure out what to buy or sell. It's trying to match an index or a certain performance of something. And Why? Because of that fact that we know that more times than not. So if you think about this, and I'm one of them, I'm still part of a financial group in the US, the guys that are part of my team that are still licensed for securities and all. If 8 out of 10 doctors weren't as successful as one, we would make a much more decisive decision on what doctor or attorney the 2 out of 10 that are successful before we hire them. Yet people don't approach their financial service advisory that way, even though statistically they would have been simply better off to put in an index fund than try to get somebody to time the market or something to that nature and all. But part of that also, Jesse, to be really, really candid, I mean, and you are, and that's why I love being interviewed by you, we're all speculators. It's just a certain percentage of us. Some are 98% speculators, some are 8%. But we like that idea. If I may, there's a game called craps. I don't know what they call it in Europe, but I guess it's craps everywhere around the world, where they toss dice, you go in a casino. And there's really two ways to bet. You bet on the guy that's shooting or gal, or against the person that's shooting. You walk over to any crap table, and 8 out of 10 people are always betting on the shooter. Yet statistically, there's no real difference whether you bet on the shooter or not. People like to be part of crowds. We don't want to be loners. We don't want to be separate people. We're followers. We're not leaders. And the game of craps is a really good way of looking at how the markets have been now. And you're right, for a lot of decades, for a lot of reasons, markets were helped along and pushed. Now the likelihood is that for them to balance out, we're going to have underperformance for a while. The older you are, the less you can afford that underperformance. So your age is as important, if not more, than the dollars you have now. You could be 70 now with $3 million, or 40 years old with 400,000, but the 400,000 person could be far more speculative. If we're right and there is this downturn, you can't afford loss of principal now. Listen, the biggest fear before we end this, and it's all in our polls, and it's probably in Europe too, Jess, more people at 65 and over are fearful of running out of money than dying. And if you think about that, especially when your mortality, I'm 68, stares me in the face now, Jesse. When I was your age, I'm living forever. Now I'm 68. It's not uncommon that somebody would pick up the phone or, hey, Pete Grandich passed. Most people my age or older are more concerned about running out of money than dying. And that is a really, really underutilized thinking process that people in the financial world are not undertaking. That when you sit down with those people, that the thought that they may not have money to even get by in a day, I think is an awful responsibility that we're not taking as financial people into consideration. Protection of principle. I'll leave you with this. My number one argument in our meetings is it's not how much you make, but how much you don't lose now going forward, which are going to separate the winners from the losers.
Fantastic conversation, Peter. Greatly enjoyed it. I know the audience will as well. For those who want to hear more from you, where's the best place to go? I know you're very active on Twitter/X. You've got your own YouTube channel where you do interviews, which I think is fantastic. You've also got Peter Grandich and company. Maybe you could fill us in on that as well.
Yeah, and I also get to interview you on occasion too,
Yes.
which has been an enjoyment. I've watched you progress. You have, in a few years' time, moved way up the ladder, my friend. It's very nice to see that, and it's very honorable for me to be speaking to you. It really is. So,
Thank you.
yeah, there is. I keep calling it Twitter. It's hard to call it X, but I have an X page. Just doesn't sound right. I have an X page, but yeah, that's where the bulk of my communicating to the public is. And then, like you said, YouTube, like this interview, when you publish it, will go out there. I interview some people at times, and then there's the blog and Peter Grandich page, and that's more useful for the people in the U.S. who may be interested in the financial services that we do and all. But thank you again. This is always, you allow me to speak. We have great conversations, and I'm afraid if I last another year or two, you're going to be surpassing me in knowledge, understanding, and success.
Well, thank you very much. I highly doubt that. I still haven't written my book yet. Maybe someday, and I'm still a beginner at all this too, which is why it's so amazing to speak to people who have a wealth of experience such as yourself. It helps me out very greatly, as well as the audience too. So thank you for that, Peter. And I'm definitely looking forward to our next conversation.
Thank you, my friend. God bless.
And thank you for joining us today. As a reminder, this episode was sponsored by ARC Silver Gold Osmium. For all your precious metals needs, head to arcsgo.com and contact owner Ian Everard at 307-264-9441 or by email at ian@arcsgo.com, and make sure to tell him that Commodity Culture sent you. And I'll see you guys in the next episode. Commodity Culture is a series on commodities and natural resources. If you would like to see more, be sure to subscribe and hit the bell notification so you're always up to date with the latest episodes.